Imagine waking up 20 years from now, your financial seeds planted today having grown into a mighty forest while everyone around you was scrambling, chasing the next hot tip. You calmly harvested the power of time itself. Today we're going to talk about the safest long-term investment strategy. Not a magic bullet, not a get-rich quick trick, but a roadmap for compounding, resilience, and long-term prosperity. When we think about building wealth in a world that constantly seeks immediacy, it's almost counterintuitive to suggest that the most powerful force in investing is not speed, not timing, but time itself. Time is your greatest ally, an invisible yet compounding engine that quietly works for you day by day, year after year, amplifying even the smallest, most disciplined decisions into exponential results. What makes time so transformative is its ability to smooth out volatility, absorb uncertainty, and reward conviction in a way that no short-term strategy can replicate. The truth is, markets don't reward impatience, they reward endurance. If you've ever studied the trajectory of innovation or the way capital markets respond to it, you'll notice a pattern. Real value creation doesn't happen in the first wave of enthusiasm. It happens when the hype fades, when the impatient capital leaves, and when the fundamentals have time to mature. The same principle applies to personal investing. Those who give their investments the room to breathe, to experience cycles of growth, contraction, and renewal, end up harnessing a mathematical phenomenon that Einstein once called the eighth wonder of the world: compounding. When your returns begin to generate their own returns, time transforms linear growth into exponential wealth creation. But compounding requires patience. It demands that you trust the process when short-term noise tempts you to abandon it. Over the decades, data has consistently reinforced this truth. Investors who stayed invested across multiple cycles, through recessions, through bubbles, through uncertainty, tend to outperform those who attempted to predict or outsmart the market. Missing even a handful of the best performing days in a decade can mean the difference between meaningful growth and stagnation, and those days rarely announce themselves in advance. They occur when sentiment is lowest, when fear dominates, when the market tests your conviction. Time, however, gives you the luxury to look beyond those moments. It shifts your focus from what's happening now to what's possible next. Time also transforms risk. In the short run, volatility can feel punishing. Prices swing, narratives change, confidence wavers, but over long horizons, volatility gives way to trend, and the market's tendency toward growth reasserts itself. The longer your holding period, the less the daily fluctuations matter. This is why seasoned investors view time as the ultimate hedge against uncertainty. When you extend your horizon, you allow innovation, productivity, and value creation to compound on your behalf. Every correction becomes an opportunity to accumulate more of the future at a discount. Every bear market a reset that transfers wealth from the impatient to the patient. It's also essential to recognize that time changes not just your portfolio, but your perspective. Early on, you might check performance daily, reacting to every tick. Over time, however, you start thinking in terms of decades instead of days, understanding that true wealth is not about timing entry and exit. It's about alignment. With long-term structural growth, this mindset separates investors from speculators. It turns fear into discipline and discipline into freedom. When you anchor your strategy in time, you no longer need to chase trends or predict outcomes. You simply let your capital work within the unstoppable engine of progress. In a rapidly evolving world, one where technological disruption accelerates, where inflation and interest rates shift, where policy and geopolitics introduce new uncertainties, time remains the constant that ties it all together. The breakthroughs shaping tomorrow's economy may take years to realize their potential, but those who position early and hold through the noise capture the true asymmetry of return. This is the essence of visionary investing, the willingness to wait for innovation to scale, to let adoption curves mature, to allow productivity gains to flow through to earnings and valuations. Ultimately, the greatest investors aren't those who move fastest. They're those who wait longest with the highest conviction. Time transforms volatility into opportunity, uncertainty into wisdom, and disciplined patience into exponential growth. When you align your portfolio with long-term trends and give it the runway it deserves, you're not just investing, you're compounding progress itself. Time is your most loyal partner in this journey. Use it, trust it, and it will quietly do what no trade, no algorithm, no forecast ever can. It will make your patience profoundly profitable. The foundation of every resilient investment strategy rests on three timeless principles: diversification, low cost, and discipline. These are not glamorous concepts. They don't make headlines, nor do they promise instant gratification. Yet they are the quiet architects of enduring wealth creation. In a market environment increasingly defined by short-term noise, algorithmic reactions, and emotional decision-making, these principles serve as the compass that keeps you aligned with long-term progress rather than distraction. Diversification is the ultimate acknowledgement of humility in investing. It's the recognition that no one can predict with precision which sector, company, or asset will outperform in the short term. By spreading your exposure across industries, geographies, and even asset classes, you're not diluting conviction, you're safeguarding it. True diversification allows innovation, productivity, and different economic cycles to work in harmony rather than in conflict. When one part of the market falters, another often rises. This balance gives portfolios the ability to endure shocks and recover faster, transforming volatility from something to fear into something that simply rebalances opportunity. Diversification is not about owning everything. It's about owning intelligently, allocating capital to a mix of growth and stability, risk and reward, legacy and future. But diversification alone is not enough if the cost of investing quietly eats away at the return it generates. Every percentage point spent on fees, taxes, or inefficiencies is a percentage point lost to compounding. That is why a low-cost structure is not just prudent, it's essential. The mathematics are undeniable. Over decades, high expenses can erode returns as surely as poor decisions can. The beauty of today's financial landscape is that innovation has democratized access to low-cost vehicles, index funds, ETFs, and commission-free platforms. This shift empowers investors to participate in global growth without being penalized by intermediaries. By keeping costs low, you let compounding work unhindered, allowing your returns to grow on top of one another, untouched by unnecessary friction. Low cost is the silent multiplier of wealth, the invisible fuel that lets time and performance do their work. Still, even with a diversified, low-cost portfolio, success ultimately comes down to behavior. Discipline is the glue that holds the entire structure together. Without discipline, diversification becomes scattered, and low cost becomes meaningless. Discipline means staying committed to your strategy when volatility strikes. It means rebalancing methodically instead of reacting emotionally. It means ignoring the constant barrage of short-term predictions, market noise, and speculative temptation. Markets test conviction. They always have and always will. But discipline transforms those tests into triumphs. Every investor eventually faces the moment when fear and doubt urge action, but discipline reminds you that patience often outperforms panic. Discipline also operates at the level of routine, consistent contributions, periodic review, steady rebalancing. It's not a single heroic act of restraint, but a habit of consistency. The greatest investors don't just make one good decision. They make thousands of small, disciplined ones over time. They understand that markets reward persistence more than perfection. And in those moments when headlines scream crisis or euphoria, discipline acts as your emotional ballast, keeping your course steady and your focus clear. Together, diversification, low cost, and discipline create a self-reinforcing system. Diversification cushions you against uncertainty. Low cost amplifies your compounding potential. Discipline ensures that neither fear nor greed can derail your progress. These are not separate ideas. They are interconnected levers that, when aligned, turn volatility into opportunity and time into wealth. When executed faithfully, this triad doesn't just protect capital. It accelerates its growth across cycles, crises, and transformations. In a world where algorithms chase milliseconds and investors chase headlines, the real edge lies in patience and structure. The combination of broad exposure, efficient cost management, and unwavering discipline may appear understated, but it outperforms brilliance that burns out too quickly. It's how investors participate in the exponential arc of innovation without being consumed by the chaos around it. Over the long arc of compounding, these principles don't just safeguard your portfolio, they shape your financial destiny. When we examine the arc of economic history, what truth emerges with undeniable clarity. Over the very long haul, equities have been the most consistent engine of real wealth creation. They have rewarded patience, innovation, and conviction like no other asset class. While bonds provide stability and cash offers liquidity, equities capture the essence of progress itself. Every share represents ownership in human ingenuity in the relentless drive to solve problems, create value, and push boundaries. Investing in equities isn't simply about participating in markets. It's about aligning with the evolution of technology, productivity, and human advancement over time. Over the decades, through wars, recessions, inflation cycles, and technological revolutions, equities have demonstrated their resilience. They've absorbed shocks, adapted to change, and emerged stronger because the underlying driver innovation never stops. When productivity grows, when new industries emerge, when ideas compound into profits, equities are the natural beneficiaries. The short-term volatility that so often scares investors is merely the reflection of the market's process of discovery, of revaluing the future again and again. Yet history shows that those who endure this noise, who keep their capital aligned with growth and innovation, are ultimately rewarded with returns that far outpace inflation and fixed income. Equities are, in essence, a claim on future growth. As companies expand earnings, reinvest in new technologies, and adapt to evolving demand, they compound value over time. This dynamic explains why, despite countless crises, long-term equity investors have consistently beaten inflation and preserved purchasing power. Bonds, on the other hand, trade certainty today for limitation tomorrow. Their returns are fixed, finite, and ultimately vulnerable to inflation's silent erosion. Cash may feel safe, but it guarantees loss of real value in an expanding economy. Equities alone evolve with the economy. They are adaptive assets in a world defined by constant change. The power of equities over the long term is best understood through compounding. When a company reinvests profits to expand operations, improve efficiency, or develop breakthrough products, it fuels a feedback loop of growth. Investors who remain patient through cycles of innovation capture this exponential curve. This is the very essence of wealth building: returns on capital that continuously reinvest to create more capital. Every reinvested dividend, every share buyback, every technological leap adds another layer to this compounding structure. Over time, it's not the volatility that defines outcomes, but participation in the growth cycle. Equities also embody optimism, a belief in progress, in the human capacity to build and adapt. This optimism is not naive, it's empirically grounded. The stock market, for all its fluctuations, has historically risen as economies expand and populations grow more productive. There will always be downturns, corrections, and even crises, but these are temporary interruptions in a far larger trend. Every period of disruption has ultimately given way to innovation, from the Industrial Revolution to the digital age, from the invention of electricity to the breakthroughs of artificial intelligence. Equities translate this relentless march forward into measurable returns. Patience is what unlocks this potential. Investors who panic at volatility often miss the strongest phases of recovery. History repeatedly shows that missing just a few of the market's best days drastically reduces long-term performance. Those days often come when sentiment is lowest, when fear dominates, and when conviction is hardest to maintain. That's why the real advantage in equities doesn't come from timing the market, but from time in the market. Staying invested allows compounding to do its work quietly and powerfully over decades. It's also important to recognize that equities reward innovation far more than tradition. The companies that deliver extraordinary returns are usually those that challenge the status quo, firms that pioneer new industries or redefine existing ones. Holding equities for the long term means aligning with this cycle of creative destruction, where progress continually reshapes the global economy. Investors who embrace this dynamic understand that the market's volatility is not a flaw but a feature. It's how the system digests innovation and reassigns value to the future. So, over the very long haul, equities remain unmatched because they compound human progress itself. They reflect not just financial growth but intellectual and technological evolution. While others may seek safety in short-term certainty, those who harness the power of equities commit to the most reliable engine of wealth creation. The modern world has ever known the enduring and exponential force of innovation multiplied by time. In the world of investing, success rarely belongs to those who move the fastest or time the market with perfect precision. It belongs to those who master their own behavior. Markets are driven by emotion as much as by data, by fear and greed, by impatience and conviction, and navigating that psychological terrain is where real advantage lies. The irony is that investors often focus obsessively on predicting what will happen next, when the far greater determinant of long-term success is how they respond to what's happening now. Behavior, not timing, is the true differentiator. When we look back over decades of market history, the evidence is consistent and striking. Even the most sophisticated market timers underperform disciplined investors who simply stay the course. Those who try to jump in and out, reacting to headlines or short-term swings, often miss the market's most powerful days of recovery. Missing just a handful of those days over a decade can erase years of returns, and those days typically occur when conviction is hardest to maintain in moments of crisis, uncertainty, or panic. The human instinct for safety drives investors to sell when fear peaks and to re-enter when optimism returns, but by then, much of the upside is already gone. Behavior, in other words, costs more than volatility ever could. Behavioral discipline begins with a simple but profound truth. Markets are cyclical, but emotion is exponential. The swings of sentiment from euphoria to despair often amplify market cycles beyond fundamentals. The investor who learns to stay grounded when emotions run high gains a structural advantage over the crowd. This doesn't mean ignoring risk. It means understanding that risk and reward are intertwined, and that volatility is the price of participation in growth. The greatest investors are not those who avoid risk entirely, but those who manage it with composure and context. They act with intention when others react impulsively. Timing the market implies an illusion of control, the belief that one can consistently predict turning points or short-term movements. Yet, the market's complexity defies such precision. Every geopolitical event, policy shift, or technological breakthrough reshapes the landscape in unpredictable ways. Trying to anticipate each turn is like trying to catch every wave in the ocean, exhausting and futile. The alternative, however, is both simpler and far more powerful. Develop a consistent, repeatable process grounded in long-term conviction. When your behavior is guided by principles rather than impulses, time becomes your ally instead of your enemy. Behavior also determines how investors experience compounding. The mathematics of compounding require consistency, uninterrupted participation. Every time fear causes an investor to sell prematurely or skip reinvesting, that compounding curve flattens. Every impulsive decision interrupts the quiet, steady accumulation of wealth. The market rewards those who can detach from the immediate and think exponentially, staying invested, reinvesting dividends, and allowing capital to grow unimpeded through cycles are behavioral choices, deliberate acts of patience in a world obsessed with immediacy. Equally important is the ability to view downturns as opportunity rather than disaster. When prices fall, emotions rise, but the disciplined investor sees dislocation as a moment to accumulate future growth at a discount. This perspective doesn't come naturally. It's cultivated through understanding, preparation, and experience. Behavioral mastery isn't about suppressing emotion, it's about channeling it. It's the recognition that discomfort often signals potential, that uncertainty is the birthplace of extraordinary returns. Those who can maintain that mental clarity when others panic are the ones who capture the asymmetric rewards that follow. In essence, behavior defines the boundary between speculation and investing. Speculators react, investors respond. Speculators chase narratives, investors build frameworks. The former live in the short term, the latter in the long term. Over time, disciplined behavior compounds just as powerfully as capital does. It compounds in better decisions, steadier conviction, and greater alignment with innovation and growth. Ultimately, markets are mirrors of human behavior. They reflect collective psychology, optimism, fear, conviction, doubt, all playing out in prices and valuations. You can't control the market, but you can control your response to it. That control is your greatest edge. Behavior shapes outcomes because it determines consistency, and consistency fuels compounding. When emotion, discipline, and patience align, the need for timing fades away entirely. It's not about predicting the next move, it's about having the resilience to endure every move. Knowing that time, innovation, and conviction will reward those who stay the course.